Hey, what's going on, everybody? Welcome back to another episode of Wealth Defense Radio, the podcast. I am your host, Josh Nahosa, and I am an independent advisor representative for SWAN DFW. That stands for Sleep Well at Night. That was founded just over 10 years ago, and I am here with the man who founded SWAN DFW way back when, and that is Hector Hinojosa.
Good morning.
Hector is a certified financial planner, which is the top mark in our industry. He's been in the industry since 1995, so he's been around the block a time or two, maybe three
or four. Yeah,
it's
a big block.
Certainly not his first rodeo when it comes to retirement stuff. So why don't you tell the people that are listening or watching? If you're watching on YouTube, leave a like. If you're listening on Spotify, give us a 5-star rating.
Yeah.
Maybe comment, say what's up. But why don't you tell the people what we're talking about today?
Yeah, we touched on this topic a few episodes ago, maybe 2 episodes ago, and we keep getting questions about, okay, so Donald Trump will be president for 4 years, or his administration will be president. What does that mean to my retirement plan? And we thought, because we kept asking the question, I thought, why don't we dive a little deeper? And that's what we're going to do today. What we think, what the industry thinks, and we'll go from there.
Yeah. But first, we have our interesting news story of the day.
Wait, you're saying that this isn't going to be an interesting podcast?
Well, we got to break it up.
Okay, I got you.
For the people.
For the people.
This whole podcast is for the people.
For the people.
So, you've gotten lost before.
Maybe
going
I was
somewhere.
lost, but now I'm found.
Maybe you were looking for something.
Yes.
An endangered sea turtle wound up in the Netherlands. And this is significant because the only place that this sea turtle lives is the Gulf of Mexico. So it was...
I had a bad GPS.
Yeah, missed it by about 5,000 miles. So scientists in the Netherlands, they found it. Fishermen found it in a net. Got it. They were like, we don't recognize this. They sent it to the Netherlands aquatic science people, and they were like, this is not our turtle. Obviously, it's a wild turtle, but they were like, it's not.
Doesn't belong here?
Yeah. So after some research, they figured out it belongs back
in the Gulf of Mexico.
In the Gulf of Mexico. So they shipped it. They didn't ship it. They flew it back to a zoo in Houston, and it was released in, looks like, Galveston on Thursday.
Yeah.
So.
And by Christmas, it'll be back in the Netherlands. It just wants to take over.
That's the hope. People don't know how it happened. Some people think it's currents. Some people think it just swam 5,000 miles.
So what do you think the buddies of the turtle are going to say when they're sitting around for, I don't know, maybe Thanksgiving dinner and saying, and where did you go? I said, well, I ended up in a place called the Netherlands. And they're going... There's not a place like that. What are you talking about?
Yeah, I mean, the fish over there, the food has got to be different.
Sure.
This is the aquatic life. I mean,
the accent.
The
way people dress.
It's got to be colder.
Yeah. That's fun.
Yeah, so just missed the mark by roughly 5,000 miles.
So I wonder if that was a Google GPS or Apple something. Anyway, back to serious business. Unturtled stuff.
Yeah. So we have some charts we're going to overlay on the screen. If you're watching, this would probably be a great episode to watch on YouTube, because we'll have charts and stuff, and you won't have to visualize just the words coming out of our mouth.
Yeah.
You'll be able to see it.
Yeah.
Visually laid out for you. So let's get into some of these stats that we've compiled.
Yeah, and we're going to get into those. And I think one of the things, and we'll do a full episode, a deeper dive on this, is, one of the questions we get is, if the market is so good, why is my personal life, isn't reflecting that? And that's because The stock market, Wall Street, is trying to project out what will happen in Main Street, our lives, 6 to 9 months ahead. And so a good market today may not mean things are good on Main Street today, but it means that they're looking down the road and saying it should be good down the road. So that I think that was a disconnect that the current administration never really talked about. So yeah, there's a lag or a forecast that Wall Street does based on how well we will do down the road. So, but the main question is, okay, so now Trump is president again. What is that going to do to my retirement plan? What should I do? Mm-hmm. And we've heard everything from I need to sell everything to I need to buy everything. So somewhere in there,
somewhere in the middle,
we will strike reality. A balance. Yeah. So the very first thing we would say is, just like, this is going to sound boring, but we need a well-diversified portfolio that meets your risk tolerance. And then we'll see what the market will do with what we project the market to do with the current administration.
So we have pulled some historical numbers from different places. We'll try to cite them as we go. If not, they'll be cited in the description if we forget as we go. But let's go through. Let's talk about first, I guess, year by year in presidencies. Let's go through that number. So we're going to show some of these on the screen. The first year on the chart, 57% of the time, the green means that the market goes up.
Yes.
43% of the time, it will go down.
Yeah. And that's of every administration, whether Republican or Democrat. And it's a coin flip. And again, for further disclosure, past performance is not a guarantee of future performance. But yeah, so in year one of every administration, it's kind of a coin flip. It's almost 50-50, 43, 40, 57, 57% it goes up. So, and the reason for that, I think, that this is conjecture, is the market doesn't like uncertainty.
Yeah.
And so when somebody comes in year one, there's been a lot of promises made in the campaign, but how much of that they're really going to try to do and how actually that's going to work is really uncertain. And so many investors will sit on the sidelines and not be quite as aggressive in year one, but they will be further down the road.
So year two, that number jumps up to 65%. It goes up. 35, it goes down. Year three is the highest, actually. That's 91%. Of the time it goes up. 9% it goes down, and in year four that goes back to 82% and 18%.
And I think if my premise is right, then what's happening in year two, because now it's a third of the time we're losing money and 2/3 of the time we're making money, is we're understanding what is really going to happen, how the government is going to work. And then in year three, when we're at 90% of the time making money, we have a very good understanding of what the administration is trying to push and everything is going. As we get back into year four, it's a re-election time, either for the party or for the individual. And again, things start, there's more questions that come up, I think. But even then, in year four, right now we're in Joe Biden's fourth year, we had starting the year, we had an 82% probability, or 82% of the time in all fourth years of an administration, we were positive for the market. So that's a good thing. The further into the administration it is, the better the chance the market will do well.
Right, and I think this is numbers from Fisher Investments, and this goes all the way back to 1928, I believe, is when the numbers for these charts started. So pretty long.
Yep.
I mean, we're looking at 96 years of data here.
You're right. And wars, because and recessions and even the big market crashes of 1929 and 2008. So yeah, and so worst case in year one, and we still had a better than 50% chance of making money. And so what we hope you hear is there may be a little uncertainty, but if you stay in, the market will usually reward long-term investing. And so the other kind of question is, what if I just invested when Republicans were in office or when Democrats were in office? And what we're seeing here is if you only invested in the time Republicans were in office, average rate of return was 15.3% since 1928. But since 1950, it's only been 2.8%, which is probably a little better use of our time here. Democrats about 5.11% if you just invested when Democrats were in power. But if you left it alone through all election years, your rate of return was 8.05%. So the point again is whether Republicans or Democrats are in the White House, although that will have, right now, regulation is going to be something that seems like it's going to be loosened, which banks like and a lot of different companies like. So more investment is going to be poured in the field, and we should get a little better return. But the point we're trying to make here is if you're buying good companies that have good customers and they're profitable and they've got a good balance sheet, you'll be rewarded.
I think this is better laid out visually on this slide here. This one's brought by Y Charts, and this is from 1950s. This is the table you were just looking at, but visualized with actual money, so you can see. So this looks like 1960. I think they start with $10,000 at the beginning of time. And if you only invested during Republican presidency, you wind up with $77,000. You can see that on the bottom right, that red tag. If you only invested during Democrat presidencies, you'd have $405,000, give or take. And then if you just stayed in through all of it, you would have $3.15 million over the course of that time.
And I'm going to share something with our audience that we don't normally share. As a CFP, one of the first things they teach us is 3.1 million is better than 400,000, which is better than 77,000. So staying in the market in a well-diversified portfolio with good companies will reward you regardless of who's in office.
Yeah, so I just think that lays it out a little better visually than the table does. Some people like graphs, some people like tables. I like graphs. I think I like that. The end number there is conveyed a little bit better for those of you guys that are visual people. Let's talk about, though, when a president is elected, either Democrat or Republican, what Congress has to do with the rates of return, because obviously Congress and the rest of the House of Representatives and stuff is not tied into the presidency. Those can swing on the other side. So let's talk about what happens when that happens. That has not happened this election. The Republicans own everything. Yeah. But it has happened in the past, so let's talk about it.
Yeah. And it is interesting that when you have a Democratic president and Democratic Congress, you're at 8.72%, and a Republican president with a Republican Congress, the average rate of return is 14.55%. But when it's split, it's the best. It's 15.72%. What I remember an old mentor of mine used to say, the market really likes the government split, because when that happens is not much gets done in Washington, because the only thing that really can get done in Washington are two things: more rules and spending more money.
Yep.
Neither one of those do markets like. So a split actually is better for the market. And this time, like you say, we're all red, we're all Republican. And so, we should do well over the next 4 years, but you can already see there's some trepidation about what is really going to happen and stuff. So again, the point is, whether Republican, Democrat, or split, staying in the market long term is a good idea.
Yeah, so the numbers he just read off and that you're looking at are for a Democratic president. This slide here is for a Republican president. You can see when Democrats have everything else, it's 1.04%.
Yeah.
But when it's split, it jumps all the way up to 12.2. When Republicans have everything, it's 11.7. So there's some variance there, obviously, but again, split seems to be...
Yeah, and it's because a company's worth is not based on who's in Washington. It's based about earnings per share. It's about market share. It's about what they're selling. It's about how profitable they are and how well run they are. Although Congress and the president will have some impact on markets in terms of regulation and so forth, most companies are going to get their worth by what they do. So again, having really, really good companies in really, really good industries is the key. And don't panic. And there'll be ups and downs, but long term you'll be rewarded.
Yep. And the last slide that shows that visualized shows $10,000 January 1st of 1926. The colors obviously here, red is a Republican president, blue is Democratic president, and you can see no matter which one, the general trend is up.
Yeah.
There have been certain down falls and dips, but overall, if you just kept your money in from 1926 to August 31st of 2020, you would have $101 million, which feels pretty good. Obviously, it's over a long period of time.
Sure. Yeah, almost 100 years. And the one thing, the fastest way to lose money is try to time the market. The whole idea is pick some good investments, get into it, and then just unless something catastrophically changes for a company, just hold on to those those big companies that are making really good products and making a really good profit. And the market will reward you, whether it's Republican or Democrat or split. We're going to have ups and downs, whether it's a Republican or Democrat or split government. And the whole investing 101 is just stay in. Don't try to outsmart the market, because that's a good way to get poor real fast.
Yep. So, if you have any questions or any thoughts or any concerns or anything that you would like to talk about on this podcast, or just your general retirement, you can call us. We have a couple of different ways you can do that. First way is via phone number. That's 888-SWAN-DFW. That's 888-792-6339. And the second way is via email address, and that is info@swandfw.net. That's info, like short for information, at swandfw.net. I think the overall takeaway here is don't panic, stay in. It's like we say, the best thing is a good retirement plan as a whole. If you're concerned about one way or the other,
And that's why we had a very good meeting with a prospect, a potential client, and she said she needed help not panicking. And that's one of the things that we would like to think that we can be the counter to the, oh my God, things are going horrible, I need to get out now. Hopefully we'll keep you in, and hopefully after a period of time you'll be grateful you stayed in. So
yeah. So give us a call, give us an email. It's free to call.
Yeah, and if you got a topic or you don't agree with me, I like the way our preacher says it. You have the right to be wrong. But if you want to express an opinion, yes, shoot us an email or put something on this, and we will be happy to discuss it with you, or any other topic financially related. Thank you guys for listening.
Yep, and we'll catch y'all in the next one.
God bless.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.